Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary. Welcome to the first day of September. Hard to believe that we just have a few more days of summer left. We're rolling into the fall season. And so I really wanted to spend just a couple of minutes to kind of outline where markets have been for the past few weeks, where the areas of strength have been, weakness, other areas that may have been kind of playing into those, as well as maybe what we could potentially expect for the future, even though this market has really been anything but traditional, ordinary, or predictable. But we'll talk about a couple of those things. And so for now, the bulls really do remain in control despite significant headwinds, geopolitical instability, some areas of fundamentals that appear to be kind of slowing down. Really, markets just have been able to continue to kind of march on. And so the idea now is, as investors, trying to kind of decide, what do we do from here? And so we're going to talk about a couple of just areas of concern that we see within the market, as well as kind of maybe ways to potentially hedge against that. But, the one thing that I would say that I do find to be concerning is just this market's dependence right now on the Federal Reserve being willing to continue to lend significant support. And so last week at the summit, Federal Reserve started to kind of make some comments about tapering. And so in my blog that I wrote, which will go out tomorrow, I talked about how the stock market had a taper tantrum, because as soon as they mentioned maybe having to start tapering some of the interventions that they have been doing really since the pandemic, markets immediately responded. They were down 3% for the day. And so very swift response where the market said, well, this isn't good. And so then the next day, the Federal Reserve came back, Jerome Powell came out and said, well, we said, yes, we're going to have to taper, but not necessarily anytime soon. We don't have a date specifically, sometime in the future, maybe at the end of the year. And so we're not looking to raise interest rates anytime soon. And so then that was kind of like enough for the market to say, oh, all right. And then the next day things kind of, moved on. But I thought that one day was very interesting to see how quickly, market sentiment changed that day. And so really right now this is a market that is really dependent upon having kind of perfection as well as having additional outside intervention. So something really, to keep in mind. So how long can we continue, this march forward without a correction? We are well overdue. S&P 500 usually has between 3 to 5 at least 5% pullbacks a year. Well, we've had 0 since January. And so we're well overdue. And that's probably, there's a whole host of reasons as to why that's been, but mainly just there's this overwhelming fear of missing out sentiment within the market. And so markets continue to reach new highs. August is traditionally a weaker month for the market, not this year. So we were positive for the month, and so we'll see if we can carry that on in September. Last September, if you'll remember, is when we had that 10% correction. Investors felt real uncomfortable with that because it had been a while since we'd had a correction, but really it was normal and it was healthy for the market. And so here's just a technical chart of the S&P 500, and so you can see our blue line here, that's our 50-day moving average. The orange line would be the 200. So these are our long-term moving averages, our short and long-term, and so our 50-day really does act as support typically. So you can see all the times they've kind of come down, and my screen does not want to stay today. Go ahead and use my clicker. So here's our taper tantrum last week when markets sold off. And so, but then we just kind of marched right back on. And so this is a pretty severe deviation that we have from both our short term and our long term. And so just what that means is that the further deviated we get from that, the more potential for significant correction, that we have, because it's almost like we're stretching that rubber band as hard as far as it'll go, but eventually it'll snap, and it's going to have to snap back the other way. So we're super deviated. I thought maybe last week we were going to be able to kind of have a little bit more of some normalcy, but again, we just kind of took right back off. And so that is just something just to kind of be aware of, that we are extended. We are also, I just thought this, as we were talking about the Federal Reserve, this is the Federal Reserve's balance sheet versus the S&P 500. You can see that as we've really been heavily reliant on the Federal Reserve keeping that balance sheet pretty heavy in order for the market to continue. And so it's going to be if they truly do decide that they're going to begin to reduce that balance sheet and stop with the purchases that they've been doing and different things, what's going to happen to the market itself, and will we be able to kind of overcome that is kind of the question. We still remain extremely deviated when we look at S&P 500 versus corporate earnings. And so, this deviation, I don't know that we've ever actually seen this in history. So you can run extended and deviated for some time, as we have, but this is really remarkable just when we look at earnings versus the valuations of the market. Again, I'm not saying that the market's going to crash tomorrow. We remain fully invested. All of our allocations are 100% where we, our typical intentions would be. But it is something just to keep in mind that this is really the time as investors that we want to make sure that we understand where we're allocated and why. And if you feel like a 10% short-term correction would be really, really painful or disruptive to you, then it may mean that you want to make sure that you are invested appropriately and that you have the right asset, exposure of equities versus bonds, because it is likely that at least in the short term we'll see some sort of a pullback. Markets, they can't go on forever. They can't run extended forever. But this is a good time. The time to kind of be thinking about these things is now, not as we're in the midst of that short-term correction. And so I want to show you just where we are when we look at relative strength within the market, because one of the biggest to achieve long-term success is that you want to kind of overweight your areas of positive increasing strength and kind of avoid those areas that are the laggards. And so right now, this is, as we look at all the asset classes and all of the sectors, this just kind of ranks them based on relative strength. S&P 500 has been in the number one slot for months and months and months. So there's nothing stronger than the S&P 500 right now. Shortly followed though by technology and then financials. And so tech and financials, they've been kind of like leapfrogging over each other. Tech actually had fallen out of favor back in February, March, if you remember, but that was when inflationary pressures were rising, and there were some concerns about how that would really affect the bottom line of corporations, specifically big tech. But since inflation's kind of leveled out now, technology's really come back into favor. And then U.S. small cap, mid cap, and real estate. So real estate is really interesting. So that's something that we've been watching for months. It's really been on the move over the past 3, 4, 5 months. And so we've seen that relative strength be able to increase. And then when we look at Dolly, kind of the same idea. So small growth, mid growth, and then we can see large is actually still trailing those other areas. Consumer cyclicals, technology, and financials are going to be the top 3 best sectors that have, when we look at relative strength. But real estate has moved from being really far at the back to really kind of coming up, and so that's something that we've been watching. We've made some changes to our allocations based upon some changes that we've seen in Dolly over the past couple months. As we begin to see some trends beginning to shift, we've been able to make some updates as a result of that. So moving forward through September, will we have a replay of last year where we had that 10%, correction? I'm not sure. September tends to be a weaker month of the market, but like I said before, so does August, and August wound up being positive. So typically August, September are weaker, and then as we get into October, November, December, they tend to be stronger times of the market as we kind of get into that end of the year push. And so it'll be interesting to see if those, if that holds true for us this year. Again, nothing really has been normal this year. We've had 7 really strong months without any type of significant pullback. So we'll have to see, what happens over these next few weeks. Again, just really, I think, important now for investors to kind of really understand this is a great time to take a look at your portfolio and say, hey, where am I invested? Why am I there? Does it still make sense for me to be there? And what is my allocation, stocks versus bonds versus cash? Am I more aggressive than I really need to be? Am I going to be uncomfortable in the short term if there's a pullback? Those are things that you may want to be reviewing and looking at. So Thank you so much for joining us. As we get back into the regular year and get out of the summer, we are getting back to weekly videos. They've been a little more sporadic through the summer. Also, as I've mentioned, we have some really exciting professionals who are lined up to come up and do some special sessions with us for our those that follow us and our clients that we think is going to be great information. So hope you enjoy these last few days of summer. Thanks for joining us. As always, if you have questions, you can always email me at ashleyr@victoryfiduciary.com. We're always happy to help. Have a great day.